Okay. So from here we are supposed to continue now. Street convention and true yield. Street convention means giving the coupon payment that they stated. Okay, stated coupon as in they will pay the coupon on the payment date, irrespective of whether that is public holiday or not. Okay, so that is called street convention. Stated coupon payment dates are referred as following. Street convention. That means paying the coupon on the payment date. But there are certain times when companies may not be working on the public holiday when the coupon payment date comes. So say for example, your coupon payment date is 30th June. Now 30th June is a public holiday, and then July, 1st July, 2nd July is also public holiday for some reason. Then you will be paid on 3rd July. So when you will be paid on 3rd July, you will get interest till 3rd July. So that is called as true yield. The yield calculated using this actual coupon payment date, because you are holding the bond for 3 more days now, right? So you will get payment for 3 more days as well. Then it is called as true yield. Have you understood this one? Okay,
Yes,
so
sir.
in short, street convention means when payment is done on the specified coupon payment date. True yield means quite possible that it might be delayed by a couple of days because of the public holidays also. So in that case, again, it will be calculated for those longer days and for those delay, and then they will be paid accordingly more. That's why it is called as true yield then. Okay, see, the coupon payment will actually be made in the next business day when it is falling on the weekend or holidays. Then it is true yield. Okay, these are just couple of terminologies. Then current yield. Current yield means what? Current yield is, okay, the formula for current yield is current yield is equal to annual dividend amount, annual, not dividend, annual interest, because it is bond, annual interest amount or annual interest payment divided by current bond price. Okay, this is called current yield. Okay, current yield. Similarly, what is, so say for example, if a company is paying you, let's say annually 100 rupees interest, and the current price is 900, imagine. So just calculate and multiply by 100. Calculate this 100 by 900 into 100.
$11.111. It's recurring.
So this is the yield, current yield. Same logic, if I say dividend yield, can you guess now? It should be annual dividend payment divided by current stock price. Okay, this is dividend yield. You got the difference? Understood this one? Same logic here. That means based on the current price, how much income you are getting through interest or through dividend. Okay.
Yes, sir. Understood.
So now, but remember this is annual, okay? Annual, entire year. Okay, now you try this sum now, current yield. Consider your 20-year $1,000 par value, 6% semi-annual. So 6% semi-annual means 6% semi-annual pay bond. So 6% is annual, paid semi-annually. Okay, that is currently trading at a flat price of flat as in clean price of the bond is 802. Calculate the current yield. So what is the formula? Formula is numerator is annual payment. Annual interest is what? 6% of 1000, which is what? 60?
Yeah.
60
So
divided
60
by
by 1000. 880
802.07 into 100. You do calculate.
into 100. So there is 7.4806. 06.
7.48%. Yeah. Fine. Okay.
Hmm. Yes.
Then what is simple yield? Simple yield means, okay, now let's take this example. A 3% 3-year 8% coupon semi-annual pay bond is priced at 90. Calculate the simple yield. First, let's calculate the current yield now. So current yield, so current yield is equal to what? Annual interest will be what? 8% of, here it says 90 rupees. That means face value must be 100. So 8% of 100 means what? 8 divided by current price is 90.165. Okay, into 100. Calculate this formula. Calculate this.
8.8726.
This is current yield. Now what is simple yield? Simple yield means, again you write the same thing. Now along with 8 rupees, in the next 3 years, you are paying only 90. See, you are paying 90.165. So in the next 3 years, this 90.165 is reaching to 100. So you are also earning this difference as well. How much is this difference coming to? Just take the difference.
9.835.
9.835. So 9.835 is the difference. This income also you are getting, but in 3 years you are getting. So each year, how much are you getting? You are not getting, but how much it is getting accrued. So here, see, you are not factoring in all compounding and all those things. It's a simple yield, simple way you are calculating. Okay, how much per year?
3.2783.
2783. So every year 3.2783 is getting accrued. So which I will add up here. 8 plus 3.2783. Okay, 8 plus 3.2783. Now calculate into 100.
200 is 327.833 then recurring.
How much is the numerator?
Okay, this one.
11.2783, correct?
Yeah.
Divided by 90.165 into 100.
12.5085.
So 12.51 percentage. That is simple yield. Okay, which is, you can think like an extension of current yield. This is simple yield. So if I have to write it like a
So we are
formula, then
adding,
yeah. If I have to write
like
it
that
like
is
a
one more
formula,
year cover. Yeah,
yeah.
sorry.
If I have to write it like a formula, then how will I do? It will be annual interest payment plus, I can say, how do I articulate this one? Face value minus present value divided by m. Okay, whole upon current price. But if this would have been premium, instead of 90, if it is trading at 110, then I have to use minus as well. You understood this sign, why I am writing minus? That much money will go away, no, from your hand then. Understood or not?
Yes, I understood.
Yeah, because if this would have been 95, imagine, then that much money, 95 or not 95, 105, then that means you are losing 5 rupees in 3
So
years.
what will call this thing FP minus PV by N, like the per year return?
That is, you can say uh, amortized discount or amortized premium.
Okay.
Okay, amortized. Okay, plus amortized discount or else minus amortized premium. If it is premium, minus it. Amortize and then minus it. Okay.
Yes.
Then yield to call and yield to worst. So what is yield to call and yield to worst? Okay. See, by the way, one more thing. So before I go ahead, uh, what I suggest you people to please start writing, blog or else in LinkedIn or, somewhere, anywhere display your knowledge. Then only during the exam time, the fear will go away. Otherwise, what will happen is you will start clinging too much on me. For everything you will either come to me, which is not going to help you much. Reason being, I can share only my knowledge with you. I cannot build your personality. Okay, so you to build your personality, what should you do? You need to accept some failures. You need to network with people. You need to share your knowledge. All these are required activity along with learning. So just learning, if you think you can clear the exam, it is not going to happen because the fear will grip you during the exam, and you will forget everything, or you will not be able to apply your mind. So that's why please build your personality. uh, Online, you form your group in Telegram or WhatsApp, and then go to LinkedIn, write some sort of blog, something you write. Did I tell you, like, couple of my trainees wrote some blog or some blog also, and some LinkedIn stuff also? Did I share it with you?
Yes, sir, you shared
I
it on the
shared,
group.
right? I shared it, right? So please, uh, similar to that, or in whichever way you like, don't think about perfections. Nobody is going to laugh at you, and if somebody is laughing also, you also feel free to laugh at yourself. It's okay. It is good to laugh at yourself. Okay, somebody says that you have not written the blog properly, there is a mistake, you also laugh at it. It will build your personality. The fear will go away, and you will learn from everything. Learn from ChatGPT, learn from Google, learn from LinkedIn, learn from Instagram. Whatever, if you want to create reels, you create reels. Okay, don't worry about how many followers will come seeing your content and how many followers, all those things. That is not your worry now. You just have to display your knowledge. That is also equally required for clearing CFA, because otherwise at the end, see, if you are here, if this is the minimum passing score, right now you are here, I can lift you up till here. Only with your personality you can go till here. Okay, so please build up that personality. Cross question me, Shravani. I never see you cross questioning me. That is also important. You don't have to accept whatever I'm speaking. So you have to think from different angle also. Like, why only this way? Why not that way? That cross questioning is also a part of your personality. Okay, otherwise what will happen? You will accept, because I have seen people, they will from the beginning till the end they are accepting everything whatever I'm speaking, and then when the exam result comes up, nothing is there. That is because they never bother to cross question and build personality, and they get scared because of the exam. As I said, in order to come out of fear, you have to build your personality. How to build your personality? Do some activity, get failed, and then become stronger. You have to fall down, then only you will get up stronger. So if you are into, like, someone who will never fall down, you will fall down very highly then on the day of the exam. So cross question me. You don't have to accept whatever I'm speaking. So cross question and display your knowledge, whatever little bit of knowledge you have. To your friends you display, in social media you display, make reels, make Instagram, whatever you are comfortable with it. Do something or other. Start in a very simple way. It is fine. But you please start doing something. Okay, otherwise just relying on me, what will happen? Every time you will come back to me only, whereas I'm not going to be there during the exam. In the exam hall I'm not going to be there. So then you will suffer. Or even if you don't come back to me, at the end what will happen, you may even get good scores also during the exam and all those things. I have seen that as well. During normal, in this test and all, you will get good scores, but in the final test you will lose the grip. Why? Because you got scared because questions came out of syllabus. Those things are possible. Then your mind will become very bookish. You want answers only from the book. And this is an international level competitive exam. You may not get all those. So that's why building the personality is equally important. More you build the personality, more you receive criticism from the people, stronger you will emerge, and you will be able to apply your own mind in the exam if you get questions out of syllabus. Otherwise only fear, because your mind will expect only what? Bookish answer. Okay, so look for practicality. You can learn from the stock market also. Look for practicality, stock exchange, trade, lose 100, 200, 500 rupees, whatever you can in your budget. It is okay to lose and learn from the stock exchange. And then discuss all those things. Watch business news channel, watch business newspaper. I have never seen you people asking me any doubts, especially Shravani asking doubts from the news channel. Okay, so that's why you are being too good, which is very good for me now. But then I'm scared about the exam then. Okay, because I want you to pass, right? It is not just that I have to feel good, oh, you are not asking any questions, and then I'm very happy. Okay, yeah, I'm happy only that you are not asking questions. But that should not become the reason for your failure. Then that is not something good for me, not even good for you. Okay, so please think about building personality. Only reading is not enough. Okay, yeah. Now, okay, coming back to the point here, yield to call, yield to worst. Let's see. Just go through this question now. See, these are various types of yield. Yield to maturity, yield to first call, yield to second call, yield to worst. So what is bonds YTM? First we will calculate. So when we calculate yield to maturity, callable bond means what? It is being called before maturity. But right now we will assume it is yield to maturity, right? So it is not callable. Okay, for a minute, let's assume that way. 5-year semi-annual bond. So it's a semi-annual bond, 5 years. You draw the timeline first. 5 years. So 1, 2, 3, 4, 5. Semi-annual bond. So 0.5, 1.5, 2.5, 3.5, 4.5. Okay. 6%. 6%, 102 is the present value. So this is 2004. This is 1st Jan 2004. So this is 1st Jan 2005. 2006. 2008. Okay. Now, uh, uh, 6 they mentioned 6%, 102. So 6%, 102. So semi-annually it will be 3, correct? This is the timeline. Okay. Now yield to maturity, right? So NIY present value, payment future value. So N will be what here?
10.
10, yeah. IY is what we need to calculate. Present value is 102 minus payment is 3, future value is 100. Calculate IY.
5.5366.
Did you multiply by 2?
Yeah, after multiplying it by 2.
5.5366%.
Yes,
You have
yes.
to
Yeah.
multiply by 2. Remember that if you don't multiply also, it will match with one of the options and you will fall into the trap. Okay. So this kind of questions for sure one you will get. Either people will make mistakes in N or else in IY or else in payment. So there is a very high chance that this
After
kind of
multiplying,
questions
we
will
got
come.
5.5366.
Yeah. Okay.
Okay.
So this question is highly expected, okay, for semi-annual bond because high chances that people will make mistakes here. Okay, this is one part. Now next one is yield to first call. So it is callable. So second, see yield to first call. It is callable at 102 on or after 1st Jan 2007. So 2007 is here. So here 102. So now you have to think as if like this is the maturity period and the future value is 102. So in this case, N will be what? N will be 1,
8,
2,
8.
3 years. 3 means 6 years, no? 6 years.
Sorry.
Okay. And IY is what we need to find out. Present value is 102. Payment is 3. Future value is 102. Just calculate IY.
5.88.
Huh?
5.88. After multiplying it by 2. Yeah, we got this.
Yeah, 5.88%. Okay. So this is called yield to first call. First call means we will think that first call date as the expiry date or maturity date. Yield to first call. Okay. Then next one. Yield to second call. Second call is what? At 101 on or after 1st Jan 2008. So 1st Jan 2008 is where? Oh, twice I wrote. This is 8. This is 9. No? This is 7. So after 1st Jan 2008, they said, right? This is 101. So I will keep this as the maturity date. So 1, 2, 3, 4 years. 4 means 8. 8.
5.66.
Okay, 5.66.
Yes.
Okay, this is 102, 3, and 101. Okay, this is yield to second call. Okay. So now which is the worst? Worst means amongst this, which is the worst? So check all the yields now. So we calculated first YTM, 5.53. Then we calculated yield to first call. Then yield to second call. Which is the worst of all this? Lowest one?
YTM.
YTM. So this is yield to worst as well. Is it okay?
Yes.
So yield to maturity 5.54 here. Yield to first call 5.88. Yield to second call 5.66. And the lowest yield is the yield to worst. Okay. Then callable bond can be viewed as an equivalent straight bond, option-free bond, or also called a straight bond, combined with a short call position. Okay. See, what do you think? Callable bond and option-free normal straight bond. Whose price will be higher? Callable bond and straight bond. Straight bond is also called option-free bond.
Callable bond.
Callable bond will be higher. Okay, why do you say that? Hmm?
So
Now,
can you repeat the question?
which bond will be higher? Rest everything, imagine there are two bonds. Rest everything is same thing. That both are for 10 years. Maturity period is 10 years. This bond is callable after 6 years, imagine. Okay.
The
And
YTM, right?
option free bond, second one is both are for 10 years. Coupon is 10 percentage. Okay. Rest or everything is normal only as usual. But one is callable after 6 years. Second one is not callable. So which
In
one?
callable bond, the bondholder gets more advantage than straight bond.
How do you say?
So,
No,
so
the
if the
issuer gets the advantage.
issuer, sorry.
So if issuer is getting the advantage,
So
then
it
in
will
that
trade at
case,
a discount, right? Callable bond.
huh,
As in
yeah,
lesser price.
yeah. See, issuer is
So
getting the advantage. That means investors are not getting the advantage because this bond can be called anytime after 6 years. That means investors are in a dilemma whether they will get payment after 6 years or not. So such bond will be priced higher than the straight bond or lower than the straight bond.
lower, like so you meant higher YTM, right? That's where I got confused.
Acha, okay. No.
So higher, it will be higher YTM for for a callable bond, right? Because
Yeah. It
since
will
it
be,
is trading
yeah.
at a discount.
Yeah. So callable bond will be trading at the lower price. So that's why price will be lower.
And
Lower
so
price.
the YTM
That's why
will be higher.
higher YTM. Yeah, higher IY or YTM. This will be higher price comparatively and lower YTM. Okay. Yeah. So now by how much? So that means callable bond is trading at the lower price. So callable bond is equal to option free bond option free bond which is trading at the higher price minus value of the call options or call option value, call options value. Okay, that means if option free bond is at 950, callable is 30, so this will be trading at 920. This is the relationship.
So the call option value is the discount, right? The amount of discount.
Yeah. Okay, now you see this one. Callable is equal to straight bond value minus call options value. Now I can look at this from the angle of, this is like being long on option free bond. Long means derivative language now. Long on
And so
option
how
free.
do we calculate this 30? Like,
Call options value, how to calculate? You will learn this for bond exactly. You will learn this in level 2, how to calculate. Okay, so you will not get this question how to calculate call options value for bond in level 1, but in level 2 you have all these topics. Okay, so you are long on option free bond and you are short on call options, short on call options of the bond. Okay, this language are you able to understand now? Okay.
can you explain this again? Like, this
Huh.
one?
It
The
means
long on
long
long.
means option free bond. More
I'm
and
buying
more,
it.
you are buying, right?
And
Now
short on call
more
option.
and more, if there are more chances to exercise, imagine for example the interest rate, when will the company call back? When the interest rate goes down in the market, then the company
Yeah.
will think that why should I pay high rate of interest to these people? So that time, imagine interest rate goes down, then what will happen? The chances of company calling back the bond goes up. That means the chances of exercising the call option call option goes up, and that time the call options value will go up, and so the callable bonds price will come down. Was I too fast? Shall I write and explain? See, company
Yes, sir.
says, okay, so company says, you think this is company is the holder. Company is the holder of call options, right? Holder of call options. They have the right. Company is the holder of call options.
Right. Yeah.
Company is the holder of call options.
Like they have the right to buy it, and for it for us it's the obligation, right? So,
Yeah. We don't have rights, right? Company is the holder of
we
call options.
yeah.
When the interest rate goes up, when the interest rate comes down, when the interest rates comes down, say for example, okay, when the interest rate comes down, like when the interest rate comes down, the probability of exercising the call option goes up. The probability of exercising the call option goes up. Like for example, imagine company pays uh, company pays let's say 8% interest rate. Company pays 8% interest rates and in the market interest rate is 5%. Market interest rate is 5%. So company is thinking, why should I pay 8% when the market is paying only 5? So chances are that they will call back. So when the interest rate is coming down, the chances of calling back the bond goes up. So calling back the bond goes up means risk is going up for the investors. When risk is going up for the investors, they will price the bond lower and lower. The chances of exercising the call options will go higher and higher. So from 30, it will go to 40. So now this bond's price will come down to 910. Have you understood this now?
Yes, sir.
Okay. Don't worry about how to exactly calculate this. That is not there in the syllabus only. That is there in level 2. Okay. How to, for callable bond, how to calculate. Okay. 1 minute. Just 1 minute. Okay. Yeah. Okay. Till here it is okay. Clear.
So is it because like the rates, the price of the bond has come down because the interest rates in the market has come down? Like, is it?
The price, the interest rate in the no. Actually, if the interest rate is now the market is behaving little different. If the interest rate is coming down, bond price should go up.
Yeah.
But here
That's
it is not going up. Now it is coming down. That you will learn further how it is happening. See, but still okay, because you asked question. Let me connect now itself. See, here normally what will happen? I told you this graph, right? See, this is 10% yield, and this is, imagine, 1,000 rupees price of the bond. Now when the interest is going up to 11%, okay, so the price will come down to 900. And when the interest rate is coming down to 9%, the bond price should go up to what? 1100. However,
yeah.
it will price yield convexity. I said that
Right.
the price will go up more. The price will go
Yeah.
to till here.
Mhm.
Okay. But imagine it is a callable bond. Now when it is a callable bond, okay, so this is supposed to go to 1150. But company said, I'm going to call back at, because interest rate is coming down, company says, I will call back at 1120. If company says I am going to pay this much only, why will the market pay more? So now this is called negative convexity. Convexity is negative. It will not go beyond
Just
1120.
yeah.
This is called negative
Yeah.
convexity.
Got it now.
It will not go beyond 1120. Why? Ideally, when the interest rate is going up, it should go up only. Let's say interest rate further goes up. It should further go up. It will not go, but an option-free bond will go. Callable bond will not go, because the company itself is valuing the bond at 1120. Then why will others value at higher rate? So company can call back at any time. So this is negative convexity will come into play at that time.
Yes.
Okay. Yeah. And so now this call, we can view the straight bond. Acha. Now, based on this, I can say option free bond is equal to option free bond is equal to callable bond plus call options value. Is it okay? Is it fine?
Yes. Like it is that difference that the company is paying, and like
Achha, 1 minute. Here they have mentioned minus. This is callable bond. So straight value bond is equal to option free bond is equal to callable bond. Option free bond is equal to plus call options value.
this is the difference, right? Like what the market rate should be, but what is
But it is a little less.
the difference between what the company is
950.
paying?
This 950 is equal to callable is 910. Option value is 40. So if this would have been an option free bond, it is 950. Okay. So this straight bond is also called option adjusted price. So callable bond plus value of call options. You can read this part and then, okay, let me know. Option adjusted price means straight bond only. It is known as option adjusted price. That means you have factored in options as well. Okay. Till here, just read. Is it okay?
Yes.
The next one, yield spread or benchmark spread, is the difference between the yield on your bond and the benchmark security. So benchmark security means with which we are comparing. Okay, normally we will compare it with government bond. Okay, so in your 5-year corporate bond has a yield means yield to maturity 6.25, and its benchmark the 5-year treasury note has a yield of 3.5. So the corporate bond has a benchmark spread of this much. Okay, so that means imagine one government bond is there. Government bond yield 10-year. Any year you may take 10-year government bond yield, you have to compare with 10-year corporate bond yield. So which yield will be higher? Government bond yield or corporate bond yield? Any guess, random guess?
Is it corporate bond?
Yeah, why so? Correct.
I'm not sure about the reason.
Yeah, see, the reason is where is more risk?
Corporate bond.
So corporate bond has to pay you more to take money from you.
Right.
Otherwise, why will you give your money? Got it?
Yes.
Okay, so government bond, people are in queue to give money to them. So what will they do? They will pay less only. Okay, so if government bond is giving 7%, corporate bond will give maybe 9%, let's say. See, this is all what I was trying to say sometime. You have to be a part of the market. So now we are learning bond, right? So what you should do is you buy at least one bond in your lifetime, and one bond's price will be what, hardly maybe 1,000 rupees or maximum 10,000 rupees. If you search, you might get for 1,000 also, or if not,
From where should we buy it? So like
I'll tell
what?
you. If not, maximum 10,000. But 10,000 also it is worth, because you are not losing out any money, right? You are going to be paid highly good interest rate, maybe 9%, 10% you will get. So 9% means what? Out of 10,000, for 1,090, so you will get 900 rupees, right? So which is okay. You are getting some money, right? You invest, you will get some money and feel the experience. Okay, and when you go for interview, you can share that experience. Nobody is going to ask you how much money you have invested. People will ask your experience. Tell me, what have you learned? So that time you will share your experience. You don't have to tell them like, I purchased only one bond and all that thing. Now, how to get this? As simple as, even if you type anywhere in chat GPT also, how do I buy bond in India, or how do I buy bond in Google, you will get all the answers. But first of all, you should get questions in your mind. That is more important. Answers, it's very easy. Now there are many platforms, like Win 12th. Now if you search also like this, automatically YouTube and Google will do rest of the work. They will keep bringing you this kind of ads when you watch YouTube channel also. So Win 12th, you can go to this platform, Win 12th, Golden Pie, goldenpie.com, win12th.com, okay, goldenpie.com, and there are many other. So all you have to do is, what, Win 12th is little known one. You can search this one, this link, and then go for something very simple bond and match with whatever we are learning here. See, and then you come back to me with your doubts also. If you don't understand whatever is written over there, come back to me with your doubts and buy at least one bond, cheapest bond you buy, which is available at 1,000 or 10,000 rupees. More than 10,000, you don't have to spend there. You can skip all such bonds if the price is more than 10,000. But at least spend 10,000. You are not losing 10,000, right? You are getting 900 rupees. Okay, and at the time of maturity, you will get back the money also, right? So you are not losing out on anything. And you have to. It's very important that you get the experience, and there, when you will go, you will compare. Then you will get the idea. Okay, yeah. So just go through this link, okay, win12th.com, and then go through all the bonds, and then see how many companies you have heard of, and how many companies you have not heard of, and still they are paying good returns. Why they are paying good returns? Search and come back with your questions to me, okay? Now this difference is called as what? G spread. G spread means difference between the corporate bond yield and the government bond yield. So it is what? 2%. Okay. Then so now here, see, a 3%, 3-year 8% coupon semi-annual pay bond is priced at 103.165, and 1-year and 4-year US Treasury yields are 3% and 5% respectively. Okay, calculate the G spread of the bond. Okay, calculate the G spread of the bond. Okay, so a 3-year 8% coupon semi-annual pay bond is priced at 103. 1-year and 4-year. Okay, 1-year and 4-year. Because this is a 3-year bond, let's calculate the IY for 3 years. So 3-year bond, 3-year. This is a normal corporate bond. So how will I calculate? N IY present value, payment future value. 3 semi-annual pay. So it will become 6, 4, payment will be 4, and then 100. Present value is 103. 103.165. Calculate the IY and multiply by 2. Tell me.
So it is 6.8156.
Okay. Now, next one is government bond. Now they have given 1 year and 4 year. So for 1 year, government bond is 3%.
So like I'm going through this thing, the winter thing.
Ah,
And I also like recently like they have been advertising a lot, right? And there's
yeah,
a bond
correct. Yeah.
like this bond is of Muthoot Capital, and
Ah,
the YTM is 11.25%. Like that too, it's a A plus bond. Then how come,
ah.
like, how is it possible? Like they're paying
There
such
the
a high interest rate?
investment amount, minimum investment amount will be in lakhs.
No, it's in 10,000 begin KYC. You invest
Ah, then it is good only then. What is the maturity period then?
16 months.
Huh. And how are they paying? Are they paying like every month? Then 16 months is okay. Then it is good only. Okay. You have that
Okay.
link with you.
Like I have the app. Uh,
Okay.
I'll share the screenshot just a minute.
Okay. Wait. I'll just go to this link. Can you see here? But I think it will ask me to log in. Wait.
So I've shared the screenshot.
Yeah. Muthoot Capital. Mhm.
Like if you download the app, it will pop up.
Huh.
Like 11 point.
Huh. So that is a good one only then. Okay, wait, if I can show it here in this
And the
website.
minimum investment is 10K.
So people can invest in it, no? So there is
Yeah.
nothing to lose, hardly anything to lose there.
Like what
Uh,
are the chances that it will default? Like
Very
how do
less
we?
chances.
Okay,
You
because
have to see the credit rating. I don't know
credit
why it
rating
is.
is A plus. They've mentioned over here.
Then it is okay. There is nothing to worry then.
Okay.
Okay. Now, why you are getting that high payment is because they are not, see, actually, Vint Wealth has bought the bonds at a low
Okay.
rate. They will
Okay.
resell it to you at the higher rate. So that's why they are not advertising anywhere. Like, see, they are not going to the public. That means the company did not go to the public and advertise. So they gave it, it's like a wholesale business. So Win12 got it at a lower rate, wholesale. And they, with their advertising ability, they are selling it at the higher rate to the people. They would have got much higher rate.
Higher rate as in higher YTM, right?
They would have got much higher than
Yeah.
this.
So they might have got let's say 12%, and then they are like selling it to the retail investors at 11.25.
Yes,
That's
correct,
what you mean?
correct.
Okay.
Because why did the company pay 12% to them? Because they are normally they will pay 9% only. That 3% is they don't have to advertise all those things. They could easily take money from Winthrop.
Yeah. Then there's Navi. That's also they're
Navi,
paying 11.25. But then
yeah.
Muthoot is like a reputed one, right? Compared to all these.
Which one? Muthoot.
Muthoot
Navi is
is a
also a reputed one. You know, Navi belongs to whom?
uh,
Navi is of Sachin Bansal. You heard this name? Sachin Bansal, the one who started
Flipkart.
Flipkart, that guy.
Okay. Okay.
Okay. So you can invest in that company also. It's asking me
Okay, sir. I'll
something
do.
which I don't remember
They're
also.
asking for KYC.
And what is the I think it belonged to Neogen, some company. And then yeah, this is the one that you said, but it is FinCorp 19.9.5 percentage, double A rated. See this one, Muthoot Capital, Navi. This one you said, or this one, Muthoot Capital. Okay, and
This one is
IIFL.
July. The one which I have sent you is of December 24.
Yeah, I cannot see
Like
that
the
one.
name is of December. I don't know.
Okay, let's see this one, Navi. Okay,
Yeah.
Navi, okay, 11.25. See, 11.25 percentage, maturity 22, 10,000 only you have to invest. And they are paying 11.25 percentage. What is the payment frequency? Payment frequency is, see, they are interest you will get August, September, October. So it is 90 rupees around. So this is true yield. Remember, we were seeing it is little less because of all this public holiday and all, they must be paying little, or number of days. Example, number of days might be lower. Okay. And this much is the collateral. Debt investors. So you should read all this. Okay.
Also,
So
they're like
it's
the
see, it is
AUM.
trading at premium. Future value is 10,000. It is trading at premium 10,008.
Okay.
Okay.
They are also their AUM has also increased a lot. Like
Total returns you will get 11,942. That means 1,942 will be your return. Okay. You invest this much, 10,008 rupees. There is another one also for 6 months. So at least you invest in 6 months bond, no? Normally for 6 months, 1 year, you will not, this company will not default, and hardly you are investing 10,000 rupees. So you invest and check, feel the experience. Then only one bond if you buy, it is enough in your lifetime. You can always say that you invested, because nobody will check like how much you invested. That doesn't matter. Okay, one bond 10,000 in 6 months, they are going to repay the amount. Every month they will keep paying you 90, 90, 90. So buy this bond. Okay. So you do your KYC. Then they will ask, they will say like, we will connect you to the relationship manager. Then relationship manager will call you. Follow that instructions, whatever they say. Pay 10,000 rupees. It will be a good experience for you to learn. And when you see these 90 rupees hitting in your bank account, you will feel like, okay, I have done some investments. Right? Somewhere you have to begin all this, right? Okay. So this is
Yes, sir.
that is also a good rating. Okay. Yeah. Okay. Now coming to this part again. So 1 year government bond is 3% and 4-year government bond is 5%. Okay. So how do we calculate for 3-year bond? 3 year. See, this is year 1 and year 4. YTM is 3% and 5%. So what is it for 3 year? That is the question. That interpolation only. Remember we did interpolation. See, in 3 years, 2, 3, 4, it is moving by 2%. In 3 years, it is moving by 2%. In 3 years, it is moving by 2%. So in 1 year, how much it will move by? So it will be 2% divided by 3, right? How much calculate?
0.66,
2% divided by
0.67.
3.
Yeah.
0.67% each year. So
Yes.
for 1 year, it is 3%. So for second year, it will be 3.67. Third year, it will be plus 0.67 you do.
3.67.
3.67 plus 0.67.
4.34.
4.34%. So for 3 year, it is what? 4.34%. And this difference is what? This difference is the G spread. Calculate the difference.
2.4756.
2.4756. Yeah. So that is 2.47748449. 6.82. This is okay. And here it is 4.33. That is all decimal things okay. Understood this one now?
Yes.
Shravani, understood this?
Yes, sir.
So can you just like give an overview of this thing, what we did?
Yeah. See, what we have done is just we have calculated G spread. So to calculate G spread, first we calculated the corporate bond yield. Now
Yeah.
we wanted the corresponding government bond yield. The problem is it was not there. Why? Because our corporate bond is for 3 years, but
Right.
our government bond is for 1 year and 4 years. So we interpolated and calculated the yield for 3 years through this proportional
Okay.
method or
Third year
interpolation method or
government,
matrix method. Hmm?
3-year government bond yield, right?
Yeah,
We
we have
calculate.
calculated using matrix or interpolation method.
Okay.
Okay, so which came as 4.34%. And now we are finding the difference. The difference is the G spread. Understood this one? Okay.
Yes.
Then I spread. I spread is it represents the extra return of your bond in excess of interbank MRR used in swap contracts. So yield spread relative to swap contracts, swap rates. So I spread is equal to extra return on your bond in excess of interbank MRR rates used in swap contracts. So how do I write this? Using government bond as the benchmark is to use the rate for interest rate swaps in the same currency. So this will be an alternative to using government bond yield as benchmark is to use rates for interest rate swaps in the same currencies. So this is bond yield. That means that corporate bond yield minus swap rates, interest rate swaps, yield spread relative to swap rates. Yeah. Swap rates means, I think, remember we did last time par rate or swap rate. I calculated to prove that initially that the value of the swap is 0.
Yes, so we did
Remember
that in
that one?
derivatives.
That one. Derivatives. So corporate bond yield minus swap rate is called as I spread or interpolated spread. Okay. So bond yield minus swap rate. I spread represents the extra return of your bond in excess of interbank MRR rates. So this is swap rate. Okay. So instead of comparing with government bond, I can use swap rate as well. Then next one, zero volatility and option adjusted spread. Okay. So what is zero volatility spread or option adjusted spread? Zero volatility spread or option adjusted spread. Okay. See, 1, 2, and 3 year spot rates are given. Okay. Spot rates here 1, 2, and 3. 1 year spot rates is 4%. 2 year spot rate 8.167. And then 3 year spot rate 12.377. Okay. Yeah. Consider a 3-year 9% annual corporate bond trading at 89, and its YTM is, so there is a 3-year bond. 3-year bond coupon is 9%. trading present value. IY is 13.50. Okay. Then future value is going to be 100. If nothing is mentioned, we can take, and yeah, here they said 89, so closest value 100. Present value is 89.464. Okay, this is one information given. Corporate bond. Then YTM of a 3-year treasury. So 3-year treasury bond. Treasury YTM is 12%. Okay, so this is government bond, this is corporate bond. So what is the G spread here? Calculate the G spread and Z spread. We will come to Z spread, but what is the G spread? G spread is this difference only, right? Treasury means government bond, okay? So government bond and corporate bond. So I
Yeah.
can say G spread is
1.50, right?
1.5. Yeah. So that is 1.5. Is it okay?
Yes, sir.
Yeah. Now coming to another one. What is Z spread? Okay, Z spread means what now? Z spread means okay, Z spread is Z spread means, see, now if I have to first of all imagine it is a 3-year bond. It's a 3-year bond. Coupon is 9%. Okay, coupon is 9%. Coupon is 9%. IY is not given. Think like this. If IY is not given, but these rates are given, spot rates. IY is not given. Future value is 100. What is the present value? How will I calculate? You got the question? Using the spot rates, I need to calculate. Have you done this kind of sum using spot rates?
So we'll just discount it, right?
Yeah. So 1, 2, 3. What is the cash flow? Cash flow is 9%. No? So 9, 9, 9 and 100.
Like 9
Okay.
is the coupon, right?
Coupon. Yeah.
Have they mentioned?
Now first, yeah, correct. Now first year
Okay.
spot rate is 4% raised to 1. Just calculate this. There is no shortcut for this. You have to use manual method only.
8.6538.
Store it 8.6538. Then 8.167%.
7.7160.
7.7160%. Then third one,
So I made a
1
mistake.
plus.
Just I made a calculation mistake.
Ah,
The second one is wrong. That's not 7. Like 7.7.
okay.
Just a minute, sir.
Shravani, you are also calculating, right?
Se-
Yes, sir.
7.6922.
Yeah. Huh. This is 12 point. See, I'm using these rates only. 12.377
37.
percentage raised to 3.
That is
This is
6.8.
76.
huh? It is 109. Huh.
76.8058. 93.1519.
Okay, this should be the price. All this is spot rate means these are all government rates. Okay, government bond. So if this is a government bond, it should trade at what price? 93.1519. It should be trading at 93.1519. Is it okay?
Yes, sir.
Should be trading at 93.15. But then if it is a corporate bond, at what price should it be trading at? More than 93 or less than 93? So this is a government bond.
Less than 93.
Yeah, why do you say less than 93?
Because there's high risk in corporate bonds, so the YTM should be higher in that. And hence,
Because corporate bond means people would pay less only then, because there is risk of cash flows there. So imagine this is trading at 89.464. So now it is trading at lower price. How much? 89.464. So if it is trading at this price, because it is a government bond, that means if I again calculate, okay, if I again calculate this, it means, see, I have to bring this price down. So what should I do? I have to increase this rate or I have to decrease this rate?
sorry, sir, could you please?
I have to decrease this price and move to 89 from 93. So in the denominator,
So the denominator should increase.
If I increase the denominator, this 9 will become lower. This 9 again,
Yes.
if I keep increasing the denominator, this numerator will become lower. Okay. So this numerator will become lower. So now by how much should I increase so that it reaches to 89? That is the next question. So this is, this we cannot do manually. This is done using trial and error. We have to keep on checking multiple times. Say for example, it is 1%. So I'm adding 1% everywhere. So 1%, and then this is raised to 2. Then plus 1% raised to 3. Okay. So that means this is what? 1 plus 5%. This is 1 plus 9.167% raised to 2. And this is 1 plus 13.377% raised to 3. If we do like this only, it will come to 89, let's say. But is it only 1%? That I don't know. I'm just randomly doing it. So it is called what? Trial and error method. Okay. Now this rate that I'm adding along with the spot rate, the rate that is added along with the spot rate to bring the spot rate to bring the present value of the bond equal to the market value of the bond, because I want this value to come to the market value, which is what? 89, equal to the market value of the bond, is called Z spread. So what is the Z spread in this case? I took 1%, but is it right? That I don't know. Okay,
I
that I
checked
have
it.
to see.
It comes up to 90.9147.
Here they mentioned directly, they mentioned 1.67%.
Yeah,
If
then
we
it
add
will.
1.67%, so let's check. Okay, so instead of 1%, 1.67 we will take. Okay, so plus 1.67% raised to 1. That means what? 1 plus 5.67% raised to 1. Inverse into 9. How much is the value? Tell me.
8.5170 for the first one.
Second one is plus 1.67% raised to 2. That means just add these two numbers, 8.167 plus 1.67.
So this is 9.837.
Total 9.837% plus 1 equal to.
Yeah.
Then inverse multiply by 9.
Divided by This is 7.4601.
And next one is
This one is 12.377
plus 1.67% raised to 3.
plus 1 raised to 3. So that is 73.4809.
Now you add up
Yeah,
all this.
89.458. Yeah.
89.45 or 46. Those decimal is fine.
Yes.
Shravan, you understood this?
Yes, sir.
Okay. Yeah. This is Z spread. Okay. I can do it in Excel also and show it to you. In fact, I have recorded a video also long back in Excel. I will send that also to you. You can watch that. Okay. If you want, after watching that, if you feel like you try at home to do it in Excel, because as I said, here we have to use trial and error method. We cannot manually calculate this and find out. Okay. So, but if you watch that one, it's easy only. If you still feel like I have to show it to you over here, you tell me, I'll do it. Okay. Then this option adjusted spread means what? Now this Z spread is 1.67%. This Z spread consists of 3 components. Z spread consists of 3 components. Okay, one is credit risk, liquidity risk, and then credit risk, liquidity risk, and then option risk. Okay. Credit risk, liquidity risk, option risk. Now credit risk is, so suppose here credit risk is 0.50%. Here liquidity risk is 0.25%. So what should be the option risk? Just add these two and then minus with 1.67. Huh?
0.92.
Okay. Now, because this is a callable bond, imagine. So as I said, you don't have to calculate options value in level 1. But imagine this, you don't have to calculate this credit risk and liquidity risk is there at the end. How to calculate liquidity risk. Okay, it's a simple case it is there, but otherwise little advanced you will find in level 2. Okay. Now option risk. Now suppose, now this is a callable bond. Now how do I compare with option free bond? It is disturbing me because this has option risk. So what will I do? I will remove this option to compare the risk. So option adjusted bond, option adjusted spread, option adjusted spread, that is OAS, option adjusted spread is equal to Z spread, because this entire one minus option risk. (1.67%) minus option risk is what? 0.92. So just calculate this one now.
0.75.
0.75%. Okay,
Hmm.
so now I can compare this risk with other bonds, other option-free bonds, no? Because that option has been removed, option risk. So option
Yeah.
adjusted, option has been removed. So now this has become like what? Like an option-free bond. Is it okay?
Yes.
Yeah, here it is, all this. Okay. Okay, you want 5 minutes break or you are too tired to continue, or after 5-10 minutes we can continue, or we can continue without break? What do you want me to do? Should I give you like 5-10 minutes break and then shall we continue till 10:45?
The next chapter, would it be
Huh?
more
Huh?
like the next reading? Will it be like, is it more complex?
Huh,
The
now
floating.
complexity will keep going up only. Up as in it will be like this. Something you have to keep focusing. All these are sums, no?
Okay.
Yeah. This one sum we can do. This one, yes, fresh mind is needed for this sum.
So let's do that, and can we then end the lecture like after doing
Okay.
that one?
Okay, fine. I'll do this one, floating rate yield.
Yeah.
Okay.
So we'll continue on next. Day.
Okay, fine. So floating rate note. Note means bond only, okay, FRN, floating rate. But the coupon is floating. So how do we calculate? Okay. But please, in your home, please go through the module quiz. Okay. Please go through this module quiz, because it's very scary for me when I don't get many questions from you. It looks good only for me. You are giving me less work. But then I can understand then what will happen at the end then. At the end, if you are not able to do, then it's very scary for me, right? So better I receive questions now so that later on I'm relaxed. Okay. Just go through this question. Okay. Hmm. 100,000 floating rate note with semi-annual coupon pays 180-day MRR. 180-day MRR plus quoted margin of 120. That means this is a floating rate, right? And this is for how many years? How many years is this? Uh,
5 years.
5
5
years.
years. 5 years.
Yeah. Recently.
Semi-annual. So 5 years. 1, 2, 3, 4, 5. 0.5, 1.5, 2.5, 3.5, 4.55. So now every time how much will they pay coupon? Coupon they will pay 180 day. That's how I got to know. I'll just mention here 180 day MRR plus quoted margin. That means, see, coupon is called as how much they are paying. They are paying that, whatever the MRR is. That means 180 days they are paying 180 days rate. Plus I will give you more. That more is called as quoted margin. Quoted margin. This terminology you have to remember. Okay, quoted margin. Okay. So they are paying how much? Whatever be the rate plus quoted margin is what? By default 120 basis points. 120 basis points means 1.2 percentage. Okay. 120 basis points means 1.2 percentage. 100 basis point is 1 percentage. Okay. Okay. On your reset date with 5 years remaining to maturity, the 180-day MRR is 3 percentage annualized, and the discount margin based on the issuer's credit rating is 1.5. Estimate the value. That means, see, now we have got coupon. 180-day MRR is how much? 180-day MRR is 3 percentage. So 3 percentage, that means this comes to 4.2 percentage. That means semi-annually it will be what? 2.1 rupees for 100. So 2.1 percentage. So you calculate 2.1 percentage of 100,000. We will get the payment. Let's calculate.
2,100.
Hmm?
2,100.
2,100. No? So 2,100. Okay, 2,100. Now, discount margin is 1.5. What is discount margin? See, IY is equal to what? IY, whatever IY it consists of, it is it is segregated into two parts. One is the MRR, 180-day MRR plus discount margin. That means based on the risk, extra returns. Extra. This is discount margin. You will come to know now. See, NIY, present value, payment, future value. N is what? It's a 5-year bond, right? So semi-annual 10. IY is what? IY is, they said 3% is the MRR. Discount margin is 1.5 extra spread because of its rating, whatever credit rating it has. 1.5 percentage. So this is what? 4.5. 4.5 divided by 2. Okay. 4.5, I will not put percentage, divided by 2. Present value is, that's what we need to calculate. Payment is 2,100. And future value is 100,000. Calculate the present value now.
98,670.07. 98,000. Yeah.
Huh.
Yeah.
98,670. Okay. So here the learning point is all these terminologies for a
Okay.
floating rate bond. Okay. Quoted margin, discount margin. And the rate is always annualized only. Here it says
What
180.
do they mean by reset date?
Reset means after every semi-annual, this MRR will change.
Okay, because
Next
it's
time
180.
this will be 180 day. After every 180 days. So next time if it is 4 percentage, then the coupon will be 5.2. 4 percentage plus 1.2%.
Right.
And here the discount rate will become 4 and 1.5, 5.5. So this terminologies you should be well versed.
So the initial coupon was 4.3, sorry, 3% plus 1.2. So 4.2. Okay.
Yeah.
Got it.
That fine, okay. What you do is later on you may just, if you don't read also, it's fine only, but you have to practice whatever I'm speaking here. That is very, very important. Okay. Whatever I'm doing here now, so you have to practice all this. here, yeah. See, so far, whatever I have done, you don't have to read anything much as such, but you have to practice everything. That is more important. So far, as in, you can read all the types of bond, whatever theory I was doing, that you read from the book. But whatever sums I'm doing, there, if you don't read also, it's fine, but you need to practice. Okay. And then wherever sum comes, I mean, theory comes, which is important to read, that I will tell you now, then when to read. Okay. Fine. We'll then stop now here. Okay.
Okay, sir.
Okay, sir.
Yeah.
Thank you,
Okay.
Thank
sir.
you.
Okay.
Thank you,
Bye.
sir.
Bye.
Bye, sir.
Bye.